There's some hawkish comments coming out. We've had Lael Brainard saying, look, that September pause that we heard from Rafael Bostic, not on the cards. You're seeing the data today. Try and straighten out what feels like a mixed picture for us.
Hi, Caroline. Yeah, that confusion idea about the pause is taken away today by Brainard. I think that was a very, resolute statement that's it's a hard case to pause. Now, I do think, as you highlighted, the Bank of Canada and the ECB are really on the move because their inflation rates are just charging ahead. So that's, I think, becoming more of a certain picture for markets. The Fed is obviously not going to stay behind. So maybe some of that certainty of the pricing of interest rate hikes from here is helping a bit of this lift in equities. In the end, you want certainty on policy that will allow you to get a picture on where we're going here with the economy. And it's a mixed picture. It has good data and the ISM the other day, that also decent claims today. So it may set up for a good payrolls report tomorrow, but may not be necessarily something of that it causes major uncertainty. Okay, we may hike more, may hike less. So yeah. I think this is why the market's taking as a positive Q2.
Okay, well, give us a little bit more insight as to what we're going to see tomorrow, and more importantly, how you think the market may react to it. We sort of went through a cycle, I remember years ago, where it was always sort of good news was bad news and bad news was good news when it comes to some of these employment reports. When you look at the jobless claims data that we got earlier this morning and overlay that for expectations for what we're going to see out of that monthly report tomorrow, there's a big question right now of whether this will give the Fed enough room to not only keep pace at 50 basis points, but maybe even potentially to accelerate that.
Yeah, I think remain today that Brainard gave us a qualification, right? They're looking at 4 prints from here till September, and we're on the clock for tomorrow with this number starting. Claims data is a good data point, though, to feel out what the real-time activity is in employment on the ground, and that does show robust labor market. So I do think this range of 200,000 up to 400 and change on the high, you do get some number that's in that range, if not to the upper end, I think, because the strength of the labor market hasn't really seen any material weakness. The ADP data today showed some small business decline, but that's not material enough to have, I think, derail the report. So if you're getting a good report, it will cement expectations that September is likely going to be another 50 basis point hike to ensure that inflation in the future comes down. But it's the first data point from until September to see if we've seen meaningful decline in inflation, meaningful moderation in demand. Strong number tomorrow, we'll just continue to say the economy is strong, no moderation in demand. You have to hike with more basis points than 25.
Where then do you see a 10-year yield at year end?
I have on the camp of Taylor that we should retest that 3.2% high from 2 weeks ago. I think what happened last week was somewhat mispriced. Think about this way, that we cannot really stop with hiking until we actually see conclusive evidence that inflation is really decelerating. So a 275 10-year last week was just too low. It needs to reflect a steeper path of rate hike. So I'm more on the 3.2%, if not somewhat higher from there, in order, I think, why the Fed wants this, truly ensure that inflation expectations are controlled and that financial conditions really work themselves through the economy, is working through the housing market, as Brainard says today, but not more than that yet. At least that's what she said. So I think, you're going to get more pressure on rates from here.
Yeah, and when we've got so much data, it was interesting in terminal use here previously was sort of talking about the data, the jobs data, giving more room for the Fed to raise rates. And certainly that's what Lael Brainard seemed to be saying, is that there isn't going to be any sort of a pause. From your perspective, what does this mean for the US dollar, Ben? Because it was interesting today that we did get that warning from Microsoft saying the strength of the US dollar is impacting our revenue, our forward-looking guidance for our earnings. This is likely to hit some other big exporters. Do you think the dollar is as strong as it's going to get, or have we further to run?
It has more room to run, Caroline. I think that as much as the ECB story of late, that they were coming around to start not only hiking, but perhaps hiking with also 50 basis points, did rally the euro, and that, of course, brings the dollar index down. That's now in the market. So I think the market's back to a dollar looking at really the locomotive of central banks is the Fed. And if we're all going, to a race to the top instead of in the past a race to the bottom, it concludes you that the dollar should be stronger. As much as it gets competition from other central banks like Canada or Australia and New Zealand, if you think of G10, they're all hiking rates. It's really the Fed that's driving it. So I think the dollar index has more potential to go up, meaning closer to 105, 110 type of a range, which does mean, to your point, it's going to affect earnings. It's going to affect fact, companies that are very reliant on foreign earnings hedge back the dollars and their costs, as you saw with Microsoft today, yeah, does drag on margins.